Okay, so last week we started looking at finance leases. We said that they are, when we look at leases, it's important to classify them either as finance leases or operating leases. Finance leases are actually not leases. They are just financing that's structured as leases. And we looked at finance leases from the perspective of the lessor. And we said when the lessor enters into a finance lease, he's actually selling an asset and he recognizes a lease receivable. And if you remember last week, we did this lease receivable and we did the note, a big note for a lease receivable. And we did a Ppe Note as well, isn't it? And a profit before tax note for the assignment. Today we're going to look at the finance lease from the perspective of the lessor. The lessee, and we're going to look at operating leases briefly. And operating leases, we're going to look also at lessor and lessee. Although operating leases were really examined quite a lot in second year, we don't see them much in third year, but if it comes up, it's an easy section of work. And we're also going to deal with today the tax implication of leases and deferred tax implication of leases. Okay, so I'm going to start with lessees. If I have a lessee, the lessee will do two things. He will recognize an asset and he will recognize a finance lease liability. The finance lease liability. On the asset, he will add costs to the asset just from PPE. Whatever PPE we buy, whatever costs we incur to buy that PPE gets added to the PPE, right? So our costs here get added to the asset. Remember when we did the lessor, the costs were added to the receivable, which was their asset, isn't it? Do not add costs to the finance lease liability, because it doesn't work that way. So the entry is to debit asset credit bank, right? So we would add costs, and then this asset we depreciate. And we depreciate it over either the life of the asset or the lease term. How do we know which one we're going to do? Well, if ownership passes, we always depreciate over the life of the asset, isn't it? If ownership is transferred to the lessee at some stage at the end of the lease, we would depreciate that asset over its life, regardless of what the lease term is, because the asset becomes ours at the end. Do you agree? However, if the asset does not transfer, and if you remember from last week, there are times where we recognize an asset even if it doesn't become ours. So if we are using it for most of its life and then we give it back, yeah, then we would depreciate over the lower of the life or the lease. And the reason we say lower of here is just in case the lease exceeds life, which shouldn't happen, but you never know with financing arrangements, isn't it? It could happen. And it could be that the financier believes that he's given you a truck which you're going to be able to use for 5 years, but actually because you're using it so much, you'll only use it for 4. So then we would pay for it over the 5 years, but only use it for 4. It's not the best financing arrangement to make. You're paying for an asset when you're no longer getting benefit from it or using it. So it's not the best financing arrangement, but if it happens. But just be careful when you're depreciating. If you have taken ownership of the asset, then you use life. Otherwise, we usually use lease. It's usually less than life. So that's on the asset side, and you would do the Ppe Note, etc., etc. On this side, we have our finance lease liability. The finance lease liability, we amortize. And when we amortize, we then recognize a capital repayment of the finance lease, and we recognize interest income. Interest expense, we are lessees. Interest expense. So I have a liability that I'm going to be paying over time in installments. There will be interest and capital in those installments. I need to split it. so that I am able to determine the two. And then for disclosure purposes, we need to split this into current and non-current, so that we can show it like that on the statement of financial position. Current is the capital that's due in the next year. Non-current is the capital due after that. Yeah. I just want to touch on one thing that we sometimes see when we have these finance leases with the amort tables, is that we could have a situation where we have a year end for a company which maybe is December. So our beginning of year was Jan and our year end is December. But what we might find is that the lease term runs June to June or June to July. No, it will be 30th of June, 1st of July, isn't it? So let's say July to June. And so what you find when you have that is that when you run your period balances, isn't it? You're going to get a period 1 balance, say there, and then, or let's say the lease starts here. Even if the lease starts here, we would have the lease starting there, and then your period 1 balance would be here, isn't it? And your period 1 interest is all of that, isn't it? And if our year end is smack in the middle there, what I have to do is I have to split this interest into how much goes into current year and how much goes into next year, isn't it? And when I'm looking for a balance, because I'm looking for a balance at December, I have to take the last balance and I have to add interest to it, this interest, to get me to December. Isn't it? So it's an extra step beyond your straight amort. Your straight amort, so the way that you do it is you do a straight amort first, the blues. So if you do your periods and you do interest capital for all your periods. Then you do your timeline and then you figure out where am I? And how does that relate to the periods? And then sometimes you have to then split your interest. And when you split your interest, we don't split capital, because capital doesn't split like that. But interest would split like that. So we split interest. Because do you agree that between here and here, there's no capital change? So the interest for those 6 months is the same as for those, isn't it? We split interest, and then to get a balance in December, we don't say we paid half of the capital, because we didn't. We're only going to pay all the capital in June. We take that balance and we add interest to get us to a balance there. And then to split your current and non-current, you have to do that again a year later, isn't it? So you keep having to split interest and then work out, recalc balances. But the approach is to do the blue, do your amort, and then in calcs below that say, therefore, interest for the current year is half of period 1, and for next year, half of period 1, half of period 2. Capital balance at the end of current year is from period 0 plus interest for that half, that's the December balance. For next year's December balance, period 1 plus half of period 2's interest to get us to the next December. Do you understand? So you do your blue, your amort table, then below that, you do the calcs to get you the interest and balances that you actually need for your financials, which is a different year end. So we might see that as we're practicing examples. Right, the other difficulty that we find comes with VAT. Because when you buy an asset, we don't recognize the VAT piece in the asset, isn't it? So if I buy an asset, my entry is to debit the asset for 100 Rand and to debit a VAT receivable, because I've bought an asset, SARS will give me that VAT back of 14. But my credit side, which is my payable, my liability, isn't it, is for 114. When I go to buy the asset, I have to pay inclusive of VAT. You don't pay net of VAT, you pay inclusive of VAT, isn't it? Then if you're a VAT vendor or whatever, you can claim that VAT back. So when we have VAT, this is what happens when we have VAT, is that there will be VAT in the liability, but there will not be VAT in the asset. Yeah, so just be careful with that. But also be careful with vehicles. You guys have done VAT in tax? Nothing at all. Because only commercial vehicles you're allowed to deduct the VAT. So if you own a company and the company buys you a Merc for you to drive, you're not allowed to deduct the VAT on that Merc. But if the company buys you a double cab Bucky, then it's considered to be a commercial vehicle, and then you are allowed to deduct the VAT. So be careful with that, because that can happen with VAT if they give you a VAT story. We're going to work through an example. The VAT story also has an issue then on the tax, deferred tax. So let's see where there's an example here with the VAT. Example 3. Cat entered into a finance lease at the beginning of the year, whereby it leases a machine. The lessor didn't incur any initial costs. The terms of the lease are as follows. Cost of the machine, 114, including VAT of 14. Installment, 74,618, payable annually. Lease term, 2 years. Interest rate, 20%. Ownership will transfer. So if we do the calcs for me quickly. It says prepare the journal entries for year 1 and 2. So see if you can do those journals. So remember that your first journal is acquisition journal. So the journal entries that I want to see is acquisition journal, debit assets, debit VAT, credit finance lease liability. And then I want to see journals for the installments. And the installment journals should be debit interest, debit finance lease liability, credit bank. Agree? Okay, let's see those. Do you agree? Debit the asset for 100, debit VAT for 14. You're going to claim it back from SARS. Credit your liability for 114. When you use that 114 to do your amort, you get a split of interest and capital of 22,800 and 51,818 in the first year. In the second year, finance costs 12,436, capital 62,182. Balancing to the installment that was paid of 74,618, and then depreciation charge per year of 50,000 rand. Okay. So those are your journals if they ask you for journals. Easier journals than lessor journals, yeah, because we just use one number, finance lease liability. Okay, let's talk tax. Because VAT has a tax implication, so I was going to do tax later, but I think I must do tax now since I'm talking about VAT. SARS does not distinguish between financing and operating leases. So from SARS's perspective, you are renting an asset. Yeah, you are renting an asset. So you are the lessee, you are renting an asset, yeah, and therefore SARS does not give you a wear and tear allowance. SARS does not give you a wear and tear allowance, and SARS also does not recognize that you are paying interest, because he says, no, you're paying rental. What interest? I don't see any interest. I see a rental. Yeah? So SARS will not give you a wear and tear allowance. He says you already bought the vehicle, and SARS will give you no interest deduction, because SARS will say that you are not paying interest. What SARS will give you is SARS will give you an installment deduction. He will give you a deduction which is the whole installment. So that 70 whatever we paid in that one calc, that's what SARS will give you. So because of those differences, we'll end up with a deferred tax calc that will have an asset and a finance lease liability. Let's just use those numbers for ease. Do you agree? but which will have zero tax basis. SARS is never going to give you wear and tear deductions on that asset, and he is never going to give you any deductions on the liability either. Yeah? Or rather, he is going to give you the deductions. He's going to give you, when you pay the installments, he'll give you the amounts, isn't it? So we land up with this temporary difference of 100 and minus 114 that offset each other almost, isn't it? And we land up with a small number as the net temporary difference. And that temporary difference is just going to be because as the way that you're settling your liability differs from the way that you're writing off the asset. If they matched exactly, it would be zero, isn't it? And we then land up with deferred tax. So if you get asked to do a deferred tax, that's the deferred tax. And there's an example on page of the calculation that you can reference. Page 28, you can go and flag, is an example of a deferred tax calc for a finance lease lessee, in case you get asked to do a deferred tax calc in the exam. And you see that in my deferred tax calc, I have vehicles which are reducing. They've given you both of the years. And I have a finance lease liability which is also reducing, but they're reducing at different rates. Yeah? And so I land up with big numbers, but a small liability, isn't it? A small liability which is actually growing. Started off quite small and it grows and grows, and then it looks like that liability, lease liability, will disappear, but we'll still have the asset. And then as we only have an asset, do you agree, then that minus will drop and then it will reverse. Yeah. So that's an example of a deferred tax calc for a lessee, for a finance lease. Now, when we have that, we have a little bit of a problem. And I'm going to show you using this calculation. Here's the story here. Because do you agree that on our previous example with the VAT, that SARS has already given you a VAT deduction? Yes or no? He's already given us a VAT deduction, isn't it? So when we first bought the asset, and it was a deductible asset, so just be careful with that. They will tell you, I think, though, for the third year. I put the 14,000 into a VAT receivable account, and I claimed that VAT, and SARS paid me. Okay, now, when I'm paying the liability, the 74 includes VAT, isn't it? Because I'm paying off the 114. So now SARS says, no, I can't give you twice the same amount, because he would be giving us twice the same amount, isn't it? He gave it to us when he paid us the VAT, and now we're asking for a deduction on the installment, but the installment includes VAT. So what we do is we have to adjust the installment to remove VAT. But the VAT that we will remove is the actual VAT. We never do a VAT which is an assumed VAT or an imputed VAT. VAT is what shows on the invoice. That's the VAT that shows on the invoice, 14. Yeah. If we look at the total installments, it's this times 2. So what are the total installments? 149 something. 149,236. Okay, 149,236. Okay. So that's the total of the installments. That's the total of the VAT, isn't it? So that's the proportion that we will use. So we will say the proportion of VAT in the installments is this proportion. Yeah. So therefore, how much is in that installment? And that's easy to work out because it's half, isn't it? It's 7. Or you can say that. But the reason why that sometimes doesn't work is if there's a residual. Because if there's a residual, there's VAT in the residual too, isn't it? And so when there's a VAT in the residual, you can't just say, well, 14, there's 2 installments, I'll divide by 2, because there's an amount in the residual. But if there's no residual, you could also just say, 14, there are 2 installments, I'll divide by 2. So what you'll see is that there's a 7,000 Rand of VAT in that first installment. Yeah, and there's 7,000 in the second installment. So when I say SARS allows the installments, when there's VAT and he's already allowed you the VAT, he doesn't double allow it. And the second implication of that is that when I look at my lease liability, that's the carrying amount of my lease liability. Just double check on your amort if that's what you would have got. 62? 182 was your balance, your period 1 balance, you're on your amort. So in that 62, there is also a VAT piece of 7, isn't it? So if we look at tax base is carrying amount of the liability, 62,182, less amounts deductible in future, but SARS is not going to allow the VAT, isn't it? So less the amounts excluding the VAT, and I'm left with the VAT. And so when there's VAT in a question, it affects how we recognize the asset and the liability. Asset, no VAT. Liability with VAT. And then it affects your deferred tax. Because in your lease liability is VAT. SARS will not give you a double dip. And so you need to take the VAT out, and the way we do it is we put it down as a tax base. It's an amount that will never be recovered from SARS. And so then we land up with a temporary difference that's slightly smaller, and we land up with, in this case, a deferred tax asset and not a liability. Yeah? So that is VAT and the implications of VAT. I would say that we don't normally see deferred tax being asked with leases, but you just never know, isn't it, what could come up. You saw in the assignment they said no tax, so not to worry about tax. Sometimes they ask for a simple one, and if there's no VAT, it is a simple deferred tax calc, isn't it? The tax base is always 0, and the only time they're not 0 is if there is a balance there. Okay. This is just an example 4 that I wanted to show you because I want to show you the disclosure. You won't normally get asked to do tax, so where does the disclosure start? So have a look at page, 216, I think it is. 216. 216. They're not likely to ask you to do tax and deferred tax notes because that's part of FAC3701. We mainly do it there. Of course, when you move into honors, tax is not a separate section. Tax is incorporated in whatever section of work you're doing or whatever sections of work have been asked in a question, and so they can just mix it up anywhere. But because we predominantly do tax in 3701, we normally don't get asked to do tax disclosure in any of the other modules. It's done in 3701. So here, when we're looking at a lessee and we're looking at disclosure, our first important note is this one. It's the Ppe Note. And what's important is that you specify that it is a leased asset. Otherwise, the note is the same, and then the only additional thing is an additional line at the bottom to say that the asset, the leased machine, is security for a liability, the finance lease liability. Yeah. So the statement requires that we disclose leased and owned assets separately. So if you get asked to do it, it must say leased asset or leased machine, and then at the bottom you've got to do the little security note. Then we have our finance lease liability. The finance lease liability note you'll see is quite similar to the receivable note we saw last time. Why? Both are financial instruments. This is a financial liability. The other one was a financial asset. The disclosures come out of IFRS 9, which is an IFRS 7. There's an IFRS 7 which deals with disclosures for financial instruments. So therefore the disclosures are similar except they're opposite. So you'll see, if you remember from last time, we started off with a recon. Yes, and we were reconciling the lease payments with their present value. Yeah, and in this case, the lease payments are 1,968.20, and there are 2 of them. Yeah, one in that period, one after that period, 2 in total. And the present values are the amounts that come off your amorts. So the first line is easy to do. It's your payments. So you just add up the payments in a year. That's the first line. Then the only other numbers that you need, and this is important because I spoke to you about it last week, but when you have a very long lease, you don't want to do 60 periods if you've got a 5-year monthly lease, isn't it? So what you need is you just need this balance, the total liability due at the end of the year, and then you need this balance, which is the liability due at the end of the next year. If you have those two balances, the other numbers on here are just balancing figures. This number is a balancing figure, this number is a balancing figure, that number is a balancing figure, that number is a balancing figure. They're all balancing figures. Yeah? And that's how you will do your note. You can go prove those numbers. If you have your mort, you can go and check all those numbers. Whether you have time in the exam to do that or not, I don't know, isn't it? But if you've got the balance at the end of the year and a balance a year later, then 88 is the balancing figure between what was paid and the balance. Then 170 is the balancing figure, 26 rather, is the balancing figure between the 170 and what was paid. Then working this way, that's the balancing figure of short term. Then working that way, that's the balancing figure for interest. Yeah. And look, if it's like one payment per year and it matches your year end exactly, then it's easy to get those numbers off your mort. But do you agree that if it doesn't match your year end exactly, it's difficult to get the numbers off your mort, isn't it? You have to do gymnastics all the time. So then it's easy to just balance with balancing figures. Yeah. Then there's a story. What the finance lease relates to, your descriptive story. They talk about calculations. They also say you can show your recon this way, linear, but I think the other way is better, hey, like that. And then we've got the E47 Disclosures, which is the financial piece, the split. But you can see the numbers come straight off. There's the 170, there's the 135, and there's another payable, SARS, which lands up in the same note. And then they talk about interest risk exposure. Here they've got the finance lease liability, and they've just talk about repayment dates, although we already did do that. And there's a story about liquidity. And I don't know if there's anything else. Oops. Yeah, that's it, I think. So that you could see the numbers. When you look at this lease, is it a quarterly lease or is it one that doesn't match? Let's have a look. I think it's probably quarterly. 2 machines will be leased. The lease payments are quarterly. So you see, it all matches our year end, isn't it? Because look, the lease agreement was started 1 Jan. Our year end is 31 December. And it's quarterly. So that just means that when you're doing your calcs, period 1 to 4 is the first year, period 5 to 8 is the second year, period 9 to 12 is the third year, isn't it? If you want to just combine. We did a bit of that last time, I think. All right, so I just wanted to show you the disclosures. This note, you just have to learn it, isn't it? And if they ask you for the note, you immediately write it out so that you then can go and fill in the pieces. All right, let's talk tax quickly for the lessor. We did the lessor last week, but we didn't do tax because we started the lecture talking about finance leases and then we were working on the assignment. Tax for the lessor is just the flip side of the coin of tax for the lessee. Tax for the lessor is SARS says that it's a rental. So therefore, it's interesting for the lessor. SARS gives a wear and tear allowance because the lessor owns the asset from SARS's perspective. Do you agree? It's a bit weird. From SARS's perspective, the lessor owns the asset and he's just renting it out to the other guy. Yeah. So SARS gives a wear and tear allowance, and SARS gives a deduction, taxes. SARS taxes the rent received or installment received. So there's the plus number coming in, and there's the minus number. Yeah. Remember that in our P&L, we have interest income, isn't it? Does not tax interest income because he doesn't believe that you're earning interest income. He believes that you're earning rental income, so he taxes the rental income. He gives you a wear and tear allowance and he taxes the rental income. Just be careful with this wear and tear allowance. Because if there's any legal fees or anything like that, they are excluded because they're not deductible, isn't it? So if there are any sitting in the asset, they wouldn't be, well, if you did incur any, he doesn't give you that allowance. But remember, we don't recognize that asset anyway. Do you agree? So when we do deferred tax for a lessor, it looks like this. Asset, carrying amount nil, tax base, whatever. Receivable, carrying amount X, tax base nil. Yeah. So then you land up with a temporary difference, which is a minus and a plus, which should offset to almost nothing. But it doesn't quite, again, for the same reasons, because the way we are recovering that receivable might be different or is different from the way SARS is writing off the asset. And so if you look at page, is an example of one on page 243, there's an example of a machine for a lessor, page 243. Yours won't be 43, eh? What is it, 41, 45? A deferred tax calc, a big one. 241. I keep forgetting that I've got the last year's study guide. So here you'll see that we have a machine which we don't have in our books. So carrying amount is null. But SARS does have it in his books because he says you still own the machine. It's your machine. So he's got the machine in his books and he's giving you the wear and tear and the tax base is dropping. And then we have a finance lease receivable which starts off at 280 and then drops as we're collecting the receivable, and then the two kind of offset each other, and you see quite a small difference there, 9,000 temporary difference, the next year 2,000, then the next year quite a big one, 27,000, and I think if you follow it all the way, the temporary differences eventually in year 5 disappear. And what you see is that for our receivable, we're going to collect our receivable, it looks like in 3 years, isn't it? 2001, 2002, 2003. By the time you get to 2004, we don't have a receivable anymore. But SARS is still giving us allowances in that 4th year. And so for SARS, it's only in year 5 that he has no more allowances to give. And it's only in year 5 that then our balances reverse completely. Yeah. So when you look at deferred tax, we start off in the beginning with a liability, and then the liability flips and becomes an asset, and flips and becomes a bigger asset, and then disappears in that last year. And you see the movement in temporary differences is a plus, and then a minus, isn't it, to make it disappear. So this is deferred tax from the lessor's perspective. But so there's lots of deferred tax implications with leases. But the principle is quite easy, isn't it? We do all this fancy stuff. We say it's not a lease, you bought an asset, or it's not a lease, you've sold an asset, and we recognize payables and receivables and assets and selling of assets. SARS says, what you're doing, you're just renting. So SARS doesn't recognize finance leases, he says you're just renting. And so all he does is give you the installment deduction. And the only time it gets funny is if there's VAT. But I don't expect to see that, but you just never know. It could come up, and then you're looking at it and you think, what the heck? Okay. So that's lessees, lessors. I wanted to touch on operating leases, and then we're going to practice a question with a funny period. Operating leases. It's very much the same as what we studied in second year. And the only thing that you're going to do different extra now is you're going to do deferred tax. So operating leases is, the rule is equalize. You remember it from last year? Equalize. So what does that mean? It means that my P&L charge must be equal every month. And I'm going to say month because you might not have entered into the lease right at the beginning, or you might have entered into it halfway through the year. So my operating lease expense, my P&L charge, must be equal every month. So therefore what happens is that I'll end up with either a deferred payment or a prepayment, depending how my lease is set up, isn't it? So if I had to do just a very vague example, let's assume that I'm going to pay in year 1, 100, and in year 2, 300. My total is 400. I divide by 2, my P&L charge is 200 every year. Yeah? So I pay 100 in year 1, 300 in year 2, a total of 400. I'm going to pay 200 every year. So in year 1, I'm going to debit expense, I'm going to credit bank, and then I'll end up with a credit, which is a deferred expense. Do you agree? In year 1 of 100. So I'm going to expense 200, a debit, but I only pay 100, so the rest is deferred. It's a liability. Yeah. Then in year 2, I'm still going to do a debit expense and a credit bank, but now I've got a bigger credit than a debit, so now I debit deferred expense, and the deferred expense disappears. Yes. If it was the other way around, and I had 300 up front and then 100, which gives me 400, which if I divide by 2 is still 200. Yeah. In this case, I start off with a debit, which is a prepaid expense. Yeah. A prepaid expense. And then the next year, I will credit that prepaid expense to make it disappear. So I'll end up with either a prepaid or a deferred, because what I'm paying differs from what I'm expensing. And it might differ by more or by less, isn't it? So you just put your entry in, what you paid, what you're expensing, and then you check if you land up with a credit or a debit, then you have to either debit prepaid or credit deferred. And then as it starts to swing, then it disappears. So that's operating leases. You remember it, I think, isn't it, from second year? I don't know if we did disclosure in second year. Oh, you know what I haven't talked to you about is expenses. When we have expenses on operating leases, those ones also get equalized. So, you know, in finance leases, what did I do with expenses? Added it to the asset on both of them, isn't it? So the asset for the lessee was the PPE, the asset for the lessor was the receivable. Any expenses incurred on finance leases get added to the asset. Any expenses incurred on operating leases are equalized. So what that means is if it's a 2-year lease, I write it off over the 2 years. If it's a 3-year lease, I write it off over the 3 years. So expenses on a finance lease get equalized. So I think here there are some expenses. Let's have a look. So this is the story. Oh no, I think I wanted to, this is deferred tax already. I wanted to show you the solution. So here it is. We have an initial payment of 14.4, And then for 24 months we pay 2,000, and for 24 months we pay 1,000. So the total amount is 86,400. It's over 48 months. So over 48 months it's 1,800 Rand a month. Yeah, and so that's how we will equalize. So for our first year, we will pay 14,400, and 1 year of installments, 24. We will pay 38,400. But we're only going to expense 1,800 times 12, 21,600. So in the first year, this is bank, this is expense, a debit, a credit. So you can see that I'm missing a debit, isn't it? Because I've got too much credit. So my debit is a prepaid expense of 16,800 in that first year. Yeah. Is that the bottom of that page? I think so. Oops. On operating leases. It's big disclosure. It's almost like finance lease disclosure in a way. So operating lease disclosure, we start off by talking about the minimum installments. Yeah. And the minimum installments is equalized. It's what's going to show in my P&L. Okay. So that's the amount that will show in my P&L up at the top there. But then at the bottom here, is that the amount that shows in my P&L? Oops. Yeah, 21,600. Yeah. It will show again in my P&L next year, isn't it? Because that's the amount that I'm going to show in my P&L every year. So my minimum installments in my note, and the note is on page, so you can check 261. Page 261, operating lease note. Minimum lease installments, 21,600. Then we will show a disclosure of the future minimum lease payments. And we will show, this disclosure looks like the one we had before, isn't it? We're going to show what's going to be paid in the next year and what's going to be paid after that. And if you remember my numbers, not later than 1 year, later than 1 year. See now, that A doesn't even balance. Yours does say 24? Because it's wrong, right? I was going to say that's wrong. Okay, so that's 24. It's 2,000 Rand a month for 12 months. And then this one is 24, which is 1,000 Rand a month for 24 months. And the total is then 48,000, which is the remaining amount that needs to be paid. Sorry, so the new study guide has been adjusted for that number. But you can see what's easier with this one is there's no PVing and interest, because there isn't any of that, isn't it? It's just a disclosure of what would be in P&L, and then a disclosure of actual cash that needs to be paid, yeah, so that our shareholders can see this is what will be expensed and this is what will be cash. Yeah. Okay. In a real life scenario, I've been involved in preparation of financial statements, and getting this done can be like a real mission. You have to go and dig up all the operating leases that you have, because they lie hidden or really anywhere. They'll end up as just a rental expense that comes off even sometimes as a debit order, isn't it, every month? And then nobody's ever really looked at the lease or whatever. When they signed it, somebody looked at it, but after that, we don't worry about it. It doesn't land up in our financials anywhere. So then you have to go dig up all these lease agreements to try and identify what the future payments will be for the disclosure. The clients hate having to do that, but it is one of the required pieces of disclosure. All right, let's talk. So here, yeah, it's the same thing. This is for deferred tax, but I want to talk about deferred tax first. Okay, this one is an operating lease from the lessor's perspective. Yeah, so it's a similar scenario. monthly installments paid in advance. They even give you the cash price of the asset and all of that, but it's not necessary. It's to confuse you perhaps, to see if you think that it's a finance lease or an operating lease. But they did say it was operating. So there's a couple of things. There's a mixer. There's an oven. And there's a factory building. And they ask you to prepare the disclosure. And now you are the lessor. And you'll see that the disclosure from the lessor's perspective is similar to the disclosure for the lessee. Here's the total future amounts that will be paid by lease, by different lease, not later than a year, etc. Yeah. And the P&L, they've put the other piece into the P&L, it looks like. Or you can show it this way, later than a year. And the actual expense bits they've put into the P&L over here. The equalized bits are here in the P&L. Okay, I wanted to talk to you about tax on operating leases. And I'm just going to say the same thing again. SARS recognizes all leases as rentals. For SARS, everything is a rental. And so therefore, with operating leases, SARS allows you the installment paid or received, depending if you're the lessee or the lessor, as income or a deduction. No, it's the other way around. If you've paid an installment, you get a deduction. If you've received, you have to pay tax on it, and it's included in income. Yeah. So this one here would be this one here would be the lessee, who's leased the asset and is paying the rent. And on this side here we have the lessor. The lessor is receiving rent and he has to pay tax. Now, you'll see that the difference that we see here between accounting and tax is this word that I have here, which is paid or received. Because we equalize. SARS does not equalize. Yeah? So there's no equalizing for SARS. And so because there's no equalizing, our P&L will be different to SARS's P&L, isn't it? So we land up with deferred tax. And the deferred tax we land up with is either your deferred expense or your prepaid, and it's also your deferred expenses for the lease expenses, like legal fees, etc., that you've deferred. So we would have landed up with assets there or liabilities there. The tax base would always be nothing, and we would land up with temporary differences, isn't it? And the lessor and the lessee are the exact opposite of each other. So if the lessor has received money in advance, he also needs to equalize it. If the lessee has paid in advance, he needs to equalize it. So there's an example of that deferred tax liability. We're on page 270. But it's not an example. I mean, it just has the prepaid. So there's the prepaid. It's a balance in my books. There's nothing for tax, and I'll end up with a deferred tax balance. Yeah. Okay. So far, what we've looked at for leases is we've looked at, just to do a quick recap, we've looked at finance leases. We've looked at finance leases for the lessee and the lessor. We've also looked at operating leases, and we've looked at operating leases for the lessee and for the lessor. And the rules were, the lessee recognizes an asset. No, let me not do it in red. I'll do tax in red. The lessee recognizes an asset, and he recognizes a finance lease liability. The asset he depreciates, the liability he amorts. Yeah? The lessor de-recognizes an asset, and he recognizes a receivable. The receivable he amorts. Yeah? Costs go in there, and costs go in here. Because costs go in here, I therefore have to calculate an effective I before I can amort, because I've changed the PV, isn't it? Effective I change PV, because I've put costs into that balance. Okay. When I have an operating lease, the rule for both of them is the same. Equalize the payments on the lease. And when I equalize the payments on the lease, I'll end up then with a deferred expense or a prepaid. Yeah? Tax. Tax for leases. Tax is the same for this lessee and this lessee, isn't it? What does SARS say for lessees? SARS says, I will allow you the installment as a deduction. And there's no wear and tear. You don't own an asset, there's no wear and tear for you. Yeah? And the same for this lessee. Installment deduction, installment paid as a deduction, not whatever we've equalized or whatever. Yeah? Then for the lessor, SARS for the lessor says, you still own an asset, I'm going to give you wear and tear, and I'm going to tax you on the installment that you received. What does SARS say for the lessor here? He says, I'm going to tax you on the installment received, and I will give you wear and tear because it's your asset. Yeah? So from SARS's perspective, the lessee never owns an asset. It's always the lessor's asset. From SARS's perspective, the lessor will always get the wear and tear, and the lessor will get taxed on the installments that he receives. The lessee will get a tax deduction on the installments he pays, and he also doesn't have wear and tear. Whatever we do for accounting, remember for accounting we have depreciation and interest, and we have interest reverses. Whatever we do for accounting, which is to equalize, reverses. Yeah? And we'll end up therefore with deferred tax, because when everything else is cleared through, when our payable is paid and our asset is completely written off, etc., it balances, isn't it? And it goes back to zero. So that's leases. And compared to what we did in second year we did operating lessee, finance lessee, isn't it? So we hadn't done lessor, but you can see lessor is the other side, isn't it? It's just the other side, and the accounting treatment is consistent. It's the same. All right. I want us to practice one of those amorts with the mismatched time period. And there was one in last year's. I don't have a solution for it, or do I? No. Because I want you to practice doing one of those mismatches, because if you get one, and it's quite likely to get one actually in the exam, then if you've never practiced one, it's trouble. 7 Ppe Limited. I'm going to put the information up, and then I'll go and make a copy, but you can get started on the amort. Any typed letters in addition to what you already have? Nothing. This question Look at how many marks it is. 68. This is a question for 68 out of the 100 marks. Okay? Oh my goodness. When you look at the required, so when you see a question like this, you think, OMG. When you look at the required, you see that it has a number of different parts. The first part says disclose the government grant, the lease of the packaging machine, and the purchase of the refrigerating equipment in the notes to the annual financial statements for 44.5 marks. But that is a government grant with disclosure, a lease with disclosure, and it's borrowing costs with disclosure. You're buying refrigerating equipment that you're going to have borrowing costs on. 44.5 marks. Then they want you to calculate the deferred tax balance for 7.5. They want you to recalculate segments. Segments we haven't done yet, so segments for 8.5 and 7.5 segment pieces at the bottom. But the big piece is that 44.5 marks for those notes, isn't it? And the approach really is to set up your note, as you know. But what I want you to work on for today, because once you can do that, then your numbers, you have them, isn't it? I want you to work on just and the students got very confused with this paper because they said it was a government grant mixed in a lease. And it was kind of, but you're going to do the lease, record the asset, and then you're going to get the government grant, and it's just going to reduce the amount of that asset. Do you agree? So it's not, you can treat it completely separate. It doesn't have to be all mixed up. But you're not going to do the government grant, you're going to do this lease. Okay, so here's the lease. It's not really a very fancy lease. Let's just check our year end again. Sorry, the year end is May. May. Okay, so the year end is May. May 11. Did it say May 11? What did it say? May 11. 31 May 11. So year end is 31 May 11. Okay, so they say to you that the packaging machine was leased from Easy Packaging, you're the lessee. It's important that you know which one you are, because if you get them wrong, on the same day the grant was received, the cost price of the machine was 6 million rand. The interest is 11.81. The lease payments are 1,199,810, and they're payable in August every year for a period of 8 years. At the end of the lease term, ownership will pass to original at no cost. They paid a commission to enter into the agreement. All I want from you, just to see that you can handle this funny year period with the lease, and it's a long one, do you see? 8 years. We only entered into the lease, they don't say the date because it's up there, the same date the government grant was received. The government grant was received 1 September 08. 1 September 08. Okay. So this was 1 September 08 was that date there. 1 September 08. Year end is 31 May 11. I only want that recon. You know that recon? 1 year, 1 to 5, total. And that recon has installments, minimum payments is what it's called, isn't it? Minimum payments. It has interest, and it has a balance. Do you agree? And so I'm looking for 1, 2, 3 numbers, 1, 2, 3 numbers, and the totals 1, 2, 3 numbers. Okay, just that. Because if you can do that, you can do everything else for this lease. I'm going to go make a copy for you of the question. I'm sure it will be a question that will be in your paper when you then get the type letters. Okay, so those are the numbers that we need because this is our year end. So that's the lease, right? And the lease started over there and will continue because it's going to continue for 8 years. But our year end is May 11, which is here. And from the end of August, September, October, November, December, January, February, March, April, May is 9 months. Do you agree? So that's 9 months. And then it's June, July, August. 3 months there. Okay? But our year end would have started here, May 10. And so this year would have been 3 months. Okay. And then somewhere here is May 12. Yeah? 9 months again there. Okay. There are only 3 numbers I need. I need to know interest from May 10 to May 11. That's for my PBT note, and it goes in my P&L. I need to know the balance at May 11, and I need to know the balance at May 12, because that's going to be non-current. And then the balancing figure will be therefore current, because this year will be non-current, this one. Agreed? Okay. I'm just going to pull these across. I've got space to put numbers. That's what I need to know. That's all I need to know to finish every disclosure that I need for leases. Okay, so I start with the interest number. The interest number is going to be 9, sorry, let me do it in green, or in blue. My interest was blue up there. It's going to be 9 months of, 3 months of the 650,588 plus 9 months of the 585,725. Do you agree? 3 months from May until August, 9 months from there onwards. So if somebody could do that calc for me. $601,941, is it? Okay. Then I need to know the balance at May. The balance at May is going to be the balance at August before plus the interest for the 9 months, isn't it? So I want to go from there to here. So plus 9 months of interest of the 585,725. What does that give me? That's my total liability as at May. Okay, then I need the balance a year later, so I need to do the exact same thing a year later. So I'm a year later, I'm now at August 11, and I'm going to add 9 months of the next year's interest. No, I'm here, so I want to go from there for those 9 months. The interest charge next year will be 3 of that and 9 of that, but to get to the balance. Okay, so if you do that, what do you get? $4730,384. Okay, and there's my numbers. And therefore, current is the balancing figure between those two. No, but that's 5.3 million. This is 4.7 million. Can't be 300,000 or 3 million. It's got to be closer to like 600 or somewhere there. 500. 668. 478. Okay. Okay, so do you agree? Those are the numbers I need. Those are the only numbers I need. Let's have a look at the disclosure. I've given you the solution. So here in the profit before tax note, there should be an interest expense. Do you agree? Here it is. What was our number? No, I have to keep going back a number of pages and forward. 601941. It's not there. It's these two numbers here. Because remember, there were borrowing costs. So there's borrowing costs in the interest, and then some of it's been capitalized. That's that bit. So just look at whether those two are the numbers. Because remember, the question has borrowing costs. I said to you, if you recall. It's these two. Am I right? 601, whatever. Yeah, those two. Is the 601, if I go back, is this number, 601941. You would have just put 601941 because you've calculated it over there, isn't it? Okay. So there's the interest. Then we have the, it must be down here. We have this recon that I wanted you to prepare. Yeah. So you'll see that they've got an extra thing, later than 5 years. Okay, we didn't split that. We should have split it. But if you look at our current, 668,478, what did we have? 668,478, isn't it? Okay, what we needed to have done, which was something I didn't look at, is that there's actually, at that year end, it's an 8-year lease, and only 2 and a bit years have passed. So there's still one more installment at the end. Yeah. But if there wasn't, our long term would have been 4730384. 4730384. We don't have time now to go and work that out. But if we do, if we take, so that one we had, if we take these two together, 4730384, right? So if we didn't have to split it, we obviously would have had to check if it's more than 5 years. Usually it's not that long, the lease, but this one was. Okay. Then the minimum payments, those are easy to work out because it's one payment, and then this is another 4 of them, I presume, and then this is another one. Yeah. Because there are still 6 payments coming, only 2 payments have happened already, isn't it? And then this interest becomes my balancing figure. Or you can go and check the interest number, but for you to check it, you have to go and take the interest amounts in your amort and do 9 months, 3 months, 9 months, 3 months, 9 months, 3 months, isn't it always? So these are the 3 numbers you need, assuming that it's not a long lease. These are the 3 numbers that you need. Oh, in fact, let's just see. There should be a note, another piece of a note. There should be the piece that talks about current, non-current, but it's not here. Oh, they go straight into calcs. Okay, I wanted to show you this amort table because it's a horrific amort table. You see, they do this amort table where they take the amort table and they split it into 9 months, 3 months, 9 months, 3 months. So as you are getting your interest number, so the first one they didn't do that for, but from then on, as you're getting your interest number for the first period, so that they're splitting it immediately into the period from August to May and then from June to August. And they split and split, but the installment only happens at the Augusts. So you'll see the balance starts, then drops, then grows, then drops, then grows, then drops, then grows, then drops. Isn't it like that? And they do the whole thing. This is one of those UNISA things that is so misleading because you don't need all of this to do the solution, isn't it? Imagine how long it can take you to sit and do this and to halve your numbers and 9. So take every interest number times 9 months times 3 months and then add it and then take off the installment, add and take off the installment each time. Add interest, take off installment, and you'll end up with the full amount for the 8 years, isn't it? Whereas we only really needed to get the bold numbers. Yeah, so if you look at the numbers that they bold, those are the ones that they use in the solution. And the bold numbers, for me, it makes much more sense to do an amort for the lease and then to massage it to get me to year end. Because there's their bold numbers, which is the bold numbers we had. Do you recall? The 5398 and the 4730. And here's the two numbers that they put into the interest. I think it's these two, which add up to the 6 something that we had. Yeah. So there's the two bold numbers, and those two numbers together, that's all you need. You don't need all of this, isn't it? And yeah, so it's just a question of, you can see it's not easy. Hey, these amorts can be tricky. And that's the amorts that you're going to get in the exam. Okay. But we'll practice more when we get to the practicing of exam papers, and then next time I see you, because we're going to do sell and lease back. And the one question that I actually had found that was even worse than this one, because they paid 6 monthly and it didn't match, right? Was a sell and lease back. So if we have time, we'll do it in that class then. Okay. All right. So basic leases are done. We still need to do 2 sale and leasebacks and a manufacturing dealer lessor. So 3 more types of leases, but we've done 4 so far. All right. You once again make the mistake of adding costs to your lease. Only if it's a receivable do we add, only to the asset. You saw the costs and you thought, oh, I think I should just add it. Last week we did, because we were doing the lessor last week. This week the costs would be added. But if you had done the asset side, would you have added it to both? Or what do you think you would have done? Or would it have triggered? No, I probably would have triggered the Okay. Because remember, I didn't ask you to do the PPE side, but you would have had to do the PPE side, right? So maybe you would have then realized that, hang on, I'm adding it in the PPE and in the, because here's the PPE note. And there's the, is it the 15? Yeah, so here's the asset, there's the government grant, and there's the costs. Yeah. And then here's the capitalizing of borrowing costs, but it's to a different asset. You're not liking it, huh? No. But it's the least favorite module of it. All right, I'll see you guys, some of you tomorrow.